13F filings just came out, and here are 5 stocks that super investors Bill Ackman, Seth Klarman, Ray Dalio, Jeremy Grantham, and if you want to call her an investor, Kathy Wood are buying. Let's take a look at stock number 1. Stock number 1, Ray Dalio is buying Amazon. In fact, he's increasing his share of Amazon. Now, guys, in full disclosure, Amazon has owned my brain for a long time. I have not probably seen the true value in Amazon since a long time ago. Now, Ray Dalio obviously sees something I don't see. He's actually increased his holdings by 152% and now has 2.65 million shares of Amazon. So, one thing that's interesting about Amazon though, guys, it's actually pretty flat over the last 3 years. Going back to August of 2020, all-time high of 175. It's at 180 right now. Guys, we're talking about 4 years, and the stock has gone nowhere. Isn't that impressive? I remember somebody said to me recently, I'm like, oh, come on, you're full of it. I looked at it, I'm like, oh my God. In fact, at the time, Amazon was down to like 150. So it was actually down in the last 4 years, which absolutely blew my mind. So it's a $2 trillion company and an enterprise value of $2.16 trillion. This difference is the net debt. Now, guys, look at this cash flow, $48 billion. Here's why this is so effing impressive. Amazon spends a ton of money on capital expenditures to grow their network, to build their way of making life easier for the everyday consumer. But one of the things that confuses me about Amazon is this 18% gross margin. That's pretty low. Walmart has a higher gross margin. Now, a lot of people will tell me, but Paul, they're reinvesting in themselves. That hurts the gross margin. That has nothing to do with gross margin. If they build a factory that has zero effect on gross margin, zero. Gross margin is the direct cost to sell a unit or service. Now, some of the biggest parts of Amazon still is their advertising. Amazon does make it easy for sellers to sell, but they're kind of a little crazy about it. But the good news is that the crazy part of them is they're so pro-consumer. Their goal, and I love this about Jeff Bezos, he once said, everybody's trying to figure out the future and what's going to change in the future. I'm trying to figure out what will not change in the future. The answers are people want things cheaper and faster, and he's 100% right. Now, obviously, Amazon also has AWS, Amazon Web Services. They dominate the industry of that data center cloud computing. Very high margin business. But to get this revenue, how much of this revenue? Majority of this revenue is from selling product. They got to get higher margins there. They got to be able to make more money there to drive up this gross profit margin. Now, the good news is this used to be about 12%. So they've grown their gross profit quite considerably. And look at their margin in the last 12 months, 7.35 versus the 5-year average of 4.7. Now, price to free cash flow is 40. High. That's high. This 5-year price to free cash flow, 173, but it's misleading because look at this average. Let's go look at the free cash flow statement on our software. Free cash flow, 6, 17, 22, 26, negative 15, negative 17, 32, 48 in the last year. But guys, look at how much their capital expenditures increased. They started spending like crazy. And their operating income, look at the cash from operations, was $30 billion back in 2018, is $108 billion in the last 12 months. They're killing it over there. Absolutely killing it. Now, just remember, Amazon sells everything. Don't feel that just because that's the case, that Amazon will go up forever. As you've seen, Amazon has been flat for 4 years now. Now, let's put the last time I did Amazon, our stock analyzer tool. I did a 10-year analysis, 4, 7, and 10% profit margin. I actually put the lowest level was where they currently are in the last 12 months. I did 7, 12, and 17%. PE, I did 20, 23, and 26 because they're Amazon. They ain't going away. If I told you right now that Amazon's going to be gone in 10 years, your first comment would be, what the hell happened in this world and Amazon went away? And a 9% return purely for my intrinsic value, the market return, no margin of safety in there. I hit the analyze button. I have a low price of 78, a high price of 360, a middle price of 185. So it seems reasonable in the middle, but remember, I have a 12% profit margin here, which they have not hit yet. And they're probably a ways away from hitting that. So I really got to get a discount. For me, I still think Amazon's too expensive, but Ray Dalio, he's a very amazing investor. I don't know what he sees, but I'm not going to go chase him and his moves if I don't see what he sees. Stock number 2, Seth Klarman, who I love, Humana stock. Humana is one of the largest private health insurers in the U.S. with a focus on administering Medicare Advantage plans. Guys, profit margin, 1.53. 5-year profit margin, 3%. Low margin business. Dividend, they can easily afford. 5-year free cash flow, $3.2 billion. 1-year free cash flow, $3.44 billion. Low return on invested capital, but not bad. 5 years at 11%, not huge. But nothing here is sticking out to me going, yay, I love this. Big revenue growth. 10-year revenue growth, 9.7% per year. 5-year, 13% a year. 3 years, 12% per year. Now, let's go see how much of that growth was from acquisitions. So we go to our cash flow statement. We scroll down. Acquisitions. All right, so not big, not big. They sold some. Big acquisition here. Sold some. Big acquisition. So not really that bad, actually. Nothing like, this is probably a lot of internal growth and natural growth, which is awesome for them. Now, Seth Klarman, this is a new holding for him, and he bought 420,000 shares. The stock is currently at $360. So this is roughly $140 or $150 million value right now. Okay, so not bad. I don't know what his plan is with this. He's a smart guy. The price of free cash flow right now is 12.5. But the one thing I want you to know, guys, is when it comes to insurance companies, they're not valued the same way everybody else values free cash flow and things like that. They got to understand what is their return, how much money they make in that float. Are they able to stay profitable? Because here's what it is. When insurance companies take money in, their expectation is that money at some point in the future will go away 100%. So their goal is, in the time from when they bring it in till it goes away, to make money on spread. How much can they make on that, what's called float? That's how Berkshire Hathaway has made so much money. They take basically a free loan, 0% interest loan, go invest it elsewhere. Warren Buffett's done about 20% a year since he started Berkshire. A lot of people estimate that if he didn't have float, it would have been 5 or 6% lower per year, which is very substantial. But they were able to use float. So for Humana, I really encourage you, if you're in our community, have a conversation about with Dalton. Dalton understands insurance a lot better than I do. You can have a conversation with him about that. So stock number 3, Bill Ackman, Nike. Brand new holding for him. He started a position buying 3 million shares. Guys, in full disclosure, I own Nike. I don't think it's dying. I don't think it's going away. I love the fact that the stock was at 180 back in November of 2021, so a little under 3 years ago, and now is at $84 per share. Got as low as $71 just 2 weeks ago. Just 2 weeks ago, it was at $71 a share. Incredible. Price of free cash flow of 19. Might seem a little rich, but it's still Nike. Look at these returns on invested capital. 20%. Really high. Dividend. 1.78% for those of you who love it. It only eats up $2 billion of their $4.7 billion in the last 5 years and $6.6 billion last year. Some still amazing growth. Guys, I was reading that Nike screwed up by taking it. They're starting to go back to Foot Locker and other places. I don't know if that's true or not. But if they sell direct to consumers, they're going to make more money. So I still like that plan of going direct to consumer. Let them do that. Let them get that gross margin higher from 45%. Because when they go sell to a Foot Locker or store, they got to sell at half the price. So let's see what Nike analysts are saying about Nike. Well, here's the 8 pillars first. Guys, 6 check marks, 2 X's, and the 2 X's are their valuation metrics. And guys, here's what's crazy. They're at 25 and 27 after falling over 50%. That's what's crazy. This was so much higher before. Does Nike deserve a premium? 1,000%. They're a great brand. They're a great company. They dominate that world. They're one of the few athletic apparel businesses that keeps on growing. Nike deserves the premium that you would give a company like Nike. So let's go check out our analyst estimates before we do our stock analyzer tool. Okay, 378 to 636 in 2029. Not bad. Double-digit growth almost every year. And revenue growth, so much for being a dying company if the analysts are correct. 4, 5, 6% a year. Not bad. So let's go to our stock analyzer tool. What was the last time I did Nike? Pull that bad boy up. Guys, I did a 10-year analysis. I did 3, 5, and 7% revenue growth. So nothing out of the ballpark, nothing crazy, 3, 5, or 7%. Now, this is where it gets a little tricky. I did 10, 11, and 12% profit margin and free cash flow, even though that's what they've done in the past. Even though if they go direct to consumer, they should be able to drive this profit margin up quite substantially. But I'll still stay on 10, 11, and 12. PE, I put a premium. Market average of 15 to 16. PE, I put 20, 23, and 26 for both PE and price to free cash flow. And again, only a 9% desired return to get my intrinsic value. So I'm not putting any margin of safety. Guys, you have to do that if you have our software. If you don't have your software, you are crazy. Here are my values. A low price of 61, high price of 121, middle price of 87. If you bought it today and my middle assumptions occurred, make about 9.5% per year, including the dividend. Now, guys, about the software. You may have noticed if you've gone in the past, everythingmoney.com, that we limit the number of daily spots for our software and community. And the reason for that is the software as it exists today currently includes everything we have to offer for retirement, real estate, and stocks. But now we've grown so well. We have 4 YouTube channels, and behind the scenes, we're making some big changes as we continue to expand. These offers are all going to be separated, and that current offer of everything is going away very soon. You may remember, if you've been watching us since we started, that I built the software selfishly for myself so that my team and I could use it to make better financial decisions in all aspects of my money investing. But as our channel and community have grown tremendously since then, it has to become less about me and more about how we can better serve you and the community members. Now, the good news is we haven't made those changes yet. So if you join today, you'll be grandfathered in for life with all the data, all of these tools, everything we've made, and every future tool that we do make. You'll get all of it, and you will keep your price forever. This is the best deal we've ever offered. So if you're really serious about making better financial decisions, increasing your returns, and most importantly, sleeping better at night, by surrounding yourself with like-minded people, click on the link in the description below to get access to everything we have to offer before we make the changes. And I'm very, very confident it'll be the best decision you've made all year. So what is Nike worth? We showed it right there. That's why I want you to have the stock analyzer tool, because you need to make your own assumptions. When we say that investment is the present value of all future cash flows, that's what we mean. Stock number 4, Jeremy Grantham has bought a new holding, Thermo. He purchased 426,000 shares. Now, this company, Thermo Fisher Scientific, here's what they do. They sell scientific instruments and laboratory equipment, diagnostic consumables, and life science reagents. The firm operates through 4 segments as of the end of 2023: analytical technologies, specialty diagnostic products, life science solutions, and lab products and services. So, big company, $235 billion market cap, enterprise value of $277. That difference is essentially their net debt. Not fully, but about there. And they brought in $8 billion in free cash flow last year, and an average in the last 5 years of $6.5 billion. So, it's a hefty price to free cash flow, 30 times. I like the fact that their free cash flow is greater than their net income. Okay, last year. Overall, it's slightly bigger. But guys, here's what I don't like. Low return on invested capital. So I'm wondering if Jeremy Grantham is just doing this as a short-term play. Because I look at this and think, great long-term investors all talk about high returns on invested capital. And you want that in a long-term hold. You want to make sure the company can get a good return on the money that's invested in the business. All right, so let's go see what the 8 pillars look like. All right, 4 X's, 4 checks, high PE, high price to free cash flow, low ROIC, a little bit more debt than they'd like. Okay, but they grew revenue $16 billion, and along that way, grew net income 2.5 and grew free cash flow by 3.7. Okay, and they bought back a few shares. Let's see where the stock has been. It's been going up for the last 5 years. So have they been buying back expensive shares? Maybe. Oh, they look at this adorable dividend they pay, 0.24%, $500 million. That's so cute. Why would you even waste our time, guys? Oh boy, let's see what analysts are saying. Wow, big growth here. EPS growth, flat this year, but 12, 13.5%, growing to $35 per share. which would be 16, 17 times earnings in a few years, and revenue growing very little, 5, 6, 7%. So what's their gross margin here? 41%. So what they're basically saying here is revenue is going to grow, and they're probably not going to add much overhead. And with this gross margin, they can add a lot of profit to that bottom line. So I'm assuming they think this profit margin can go a lot higher from here. Or they're going to buy back a lot of shares, and that might not be a good thing. So let's see what the stock analyzer tool is. I don't think I've ever done one on Thermo. Let me look it up. Let's look at my history. I did it one time in 2023. Okay. So I did 3, 6, and 9% revenue growth. I did 12, 14, and 16% profit margin. Same with free cash flow, even though free cash flow was greater than profit. PE, I did 12, 14, and 16, probably because of this low return on invested capital. So I probably put a really low PE in here. I can already tell you right now, that's going to kill the stock. I have a 9% desired return in here. My stock price, look at this. I have 180 on the low side, 440 on the high side, 285 in the middle. Guys, Jeremy Grantham sees something I don't see in this. More power to him. I have no idea what he sees in this. And by all means, if you do, please come in the community, make a comment, let me know what you think. Stock number 5. I hated even saying investor because this is the least credible investor on this list. Kathy, the wealth destroyer Wood, has increased her position in Tesla stock by 2.6%. Guys, you know how I feel about Kathy Wood. She's not an investor. She's a hype maniac. Her ETF ARC is down or flat over the last 5 years. And she always said, look at 5-year analysis. I don't know what to say. Guys, I just literally an hour ago picked up my Tesla Cybertruck. I love Tesla with the products they make. I love Elon Musk. I just don't buy into the stock price. Now remember, this is Kathy Wood's #1 owned stock. Here's her activity going back to 2020. Purchased, sold, purchased, purchased, sold, 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 sold. These are big numbers here too. And I give her credit. She sold a lot near the top. She was practicing I give her credit. She practiced what she preaches. She loved Tesla and she kept buying. However, she keeps getting in and out of Tesla. And she puts these really high price targets on Tesla. I don't know, guys. I don't know what to say about Kathy. I just think she's a hype machine. I think at one point we did a video where in her top 20 holdings, only 17 were profitable companies. I look at that saying it's going to not work out well. And I think she's going to force herself to say, I'm retiring to spend time with family. I've accomplished everything I want to accomplish. And she will leave essentially in disgrace. That's my opinion of her. So what do analysts think about Tesla? Guys, 258, 337, 425, 607, 743. Big time EPS growth. Big time EPS growth. Big time. Revenue growth. Big time. 15, 20% revenue growth. A lot of growth there. So let's see what it is on the stock analyzer tool. Now, for those of you who love Tesla, I want to remind you, I own a Cybertruck right now. I love this thing. Separate the products from the stock price. If you fall in love with the company where you're justifying the stock price at all costs, it's going to eventually catch up to you. Keep those separate. You have to. You can love the company. You can love Elon. You can love everything about them. But if you overpay for a good thing, you're going to have problems. And my point to that is this. Look at Tesla. Tesla hit an all-time high of 415 back in November of 2021, almost 3 years ago. Revenues doubled, profits up even more than that. And guess what? The stock is down. What is it now? Down 45%. It got as low as 75% down. That's bad. Why? Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So back to the stock analyzer tool. Guys, I threw out ridiculous numbers here. 5-year analysis, 7, 20, and 60% revenue growth. 8, 20, 35% profit margin. Same for free cash flow. I put in my PE and price of free cash flow of 18, 25, and 30. 9% returns. I was doing this based on Kathy Wood's assumptions. And yeah, even in the middle assumptions were still big. It's about 11.7% return. My thing is, you better have this percent return for the downside risk of Tesla. Guys, I currently believe Tesla is a car company until they get the majority of their revenue from high margin tech. So guys, if you want to see another video of the super investors in Congress, watch our next video and don't forget to join the community. Thank you for your time.